Hello and welcome back to another episode of Smart Portfolio Strategies and Investments podcast. I'm Kerrigan Bale, and what a week to wrap up the summer trading season. Joining me as always is our chief market strategist, Hale Mercer. Hale, I've got to say, this felt like one of those weeks where the headlines were doing all the talking, but underneath there were some serious shifts happening.
Hello, and thank you for having me again, Kerrigan. Yes, Friday's sell-off had everyone focused on the daily noise, but when you step back and look at the bigger picture, we're talking about the Dow finishing August up 3.2%, S&P 500 up 1.9%. That's not accident money. That's institutional positioning, and frankly, some of the sector rotation we're seeing tells a much more interesting story than the headline grabbers.
And speaking of positioning, I know you've been diving deep into the sentiment data this week. Before we get into your picks, let's set the stage first. What's your read on where we are macro-wise?
Well, here's the thing that's got me excited. We're sitting in this sweet spot where both the VIX and the MOVE indexes are telling us to favor risk assets. That doesn't happen often, and when it does, you want to pay attention.
All right, let's break down this week's macro picture. The Fed's preferred inflation gauge, that core PCE, came in right at expectations, 2.9% year over year. Markets seem to shrug it off, but what's your take?
Look, 2.9% is exactly what Powell and company want to see right now. It's not accelerating. It's not decelerating dramatically. It's that Goldilocks scenario that keeps them on track for what everyone's expecting in September. And Kerrigan, this is crucial because when you combine that with the jobs market data we've been seeing, it gives the Fed room to maneuver without looking like they're panicking.
Right, and personal spending was up 0.5%, personal income up 0.4%. That's consumer resilience even with all the tariff talk we've been hearing.
Exactly. And that brings me to something that's really important for our listeners to understand. Yes, we're hearing about Walmart, Hormel, J.M. Smucker talking about price increases because of tariff pressures. But here's the key insight. This is essentially a stress test for the consumer. If consumers prove resilient and absorb these higher prices without dramatically cutting back spending, then those price increases stick. And we're looking at a structural boost to inflation.
So you're saying this could actually reignite inflation concerns?
That's what I'm watching, basically. These companies are testing pricing power in real time. If demand holds up despite higher prices, it signals the consumer is stronger than expected, but it also means we could see inflation expectations reset higher. That's actually a bullish setup for sectors like energy and financials that benefit from an inflationary environment while putting pressure on rate cut expectations.
Well then, let's talk about the elephant in the room. These escalating trade tensions. We've got the White House doubling tariffs on Indian goods to 50%, threatening 200% tariffs on Chinese rare earth imports. How much of a headwind is this really?
Kerrigan, this is where you have to separate the noise from the signal. Yes, trade uncertainty creates volatility, but look at what's happening. Chinese companies like Cambricon posting 4,000% revenue growth and challenging Nvidia, Beijing pushing domestic alternatives. This is the kind of environment where smart money makes outsized returns.
That's a really interesting perspective. So you're seeing this as more reshuffling than destruction?
Absolutely. And the proof is in our sentiment data. We're seeing general market sentiment move from 52.142 closes ago to 60.08 now. That's a velocity of 7.35, even with some recent deceleration. The market is digesting this uncertainty and still moving higher.
Let's dive into earnings because this week was all about the big names. Nvidia obviously got all the attention. Record $46.7 billion in Q2 revenue, but the stock fell more than 3% on Friday. What's your read on that reaction?
And it is what happens when you become the market darling. But here's what The market missed in that knee-jerk reaction. Nvidia's numbers were objectively fantastic with essentially zero China sales due to the tariff situation and export bans. 56% annual gain in data center sales without one of the world's largest markets. That's actually incredible execution.
Wait, so these record numbers were achieved with China completely out of the picture?
Exactly. And here's the kicker. NVIDIA was very clear about looking to resolve this situation and building AI infrastructure on U.S. standards globally. If they can post $46.7 billion in revenue while locked out of China, imagine what happens when that market reopens under U.S. technology leadership.
Their Q3 guidance of $54 billion matched estimates but fell short of the more bullish outlooks. Is this a case of expectations getting ahead of fundamentals?
Look, it's recalibration, and honestly, I think this is healthy. When a single stock is driving too much market sentiment, you want to see some of that froth come out. The $60 billion buyback announcement tells you management thinks the stock is undervalued after this reaction.
What about the retail earnings? We had Best Buy topping expectations but staying cautious. Gap warning about tariff margin pressure. Ulta raising guidance on beauty demand. Pretty mixed bag.
It is the kind of differentiation you want to see in a healthy market. It's not all boats rising with the tide anymore. Companies with pricing power, strong execution, and defensible moats are separating from the pack. Best Buy's caution is prudent management. Ulta's strength is real consumer preference in a category that's less price sensitive. Gap's margin pressure, that's what happens when you don't have brand pricing power in a tariff environment.
So sector and stock selection becomes even more critical in this environment?
Absolutely. And that brings us perfectly to why I'm so excited about the three names we're going to discuss today.
All right, let's get into them then. I know you've been tracking some major sector rotations this week. Start with what's leading and why.
If I had to summarize this week in one word, it would be acceleration. And I'm not just talking about price moves, I'm talking about sentiment velocity and acceleration in the data. Energy is absolutely screaming right now.
Energy? Really? I mean, it's been such a beaten down sector for so long. When was the last time we talked about the energy sector here?
That's exactly why this is so powerful. Look at the numbers. Energy sentiment is at 36.76, which is still low, but the velocity is 13.77 with acceleration of 22.51. Kerr, that acceleration number is telling us something major is shifting when a sector that's been a left for dead starts showing this kind of momentum. That's when you get those explosive moves.
And I assume this ties into your Marathon Petroleum pick?
It absolutely does, and we'll get deep into MPC in a minute. But first, let me paint the bigger picture for our listeners. We're seeing this beautiful setup where you've got energy showing this breakout momentum, financials maintaining strength at the highest sector, sentiment of 70.04, and real estate starting to accelerate as rate cut expectations build.
So talk to me about the strategic approach here. How should investors be thinking about positioning?
This is where the aggressive versus defensive framework really matters. For aggressive strategies, and I'm talking about investors who can handle volatility and want to chase momentum, energy and materials are where you want to be. These are your trend following breakout plays. Think of initial positions that you can scale into if the momentum continues.
And defensive strategies?
Defensive is all about that financial sector strength. When you see financials at 70.04 sentiment with solid velocity, even as they're consolidating, that's your high probability, lower volatility exposure. These are names you can build full positions in because the risk reward is more predictable.
Now, you mentioned real estate starting to accelerate. That's interesting because it's been such a rate sensitive play.
This is the beauty of what we're seeing, isn't it? Real estate sentiment is only at 43.98, but velocity of 15.68 with positive acceleration of 2.45 tells us institutions are starting to position for rate cuts. And here's a key catalyst that's not getting enough attention. Jerome Powell recently signaled that employment will likely take priority over inflation in their policy agenda going forward.
How does that specifically help real estate?
It's huge for the office building space. When the Fed prioritizes employment, it means they're more willing to cut rates even if inflation isn't perfectly at target. Lower rates directly benefit REITs through cheaper financing costs, but more importantly, it signals a Fed that's focused on economic growth and job creation. And where do jobs get created? In office buildings. Where do companies expand when financing gets cheaper? Premium office space like what BXP owns.
So you're seeing this as anticipatory positioning rather than reactive?
Exactly. And that's why our Boston Properties pick makes so much sense in this environment. But let me also talk about what's not working, because that's equally important.
Please do.
Consumer discretionary is showing deceleration, velocity of 5.68, but acceleration of negative 4.45. That's telling you tariff concerns and spending uncertainty are real headwinds. Consumer staples are actually stabilizing after weakness, which suggests defensive positioning is becoming more attractive there. But the key is you don't want to be chasing momentum in sectors where the acceleration is negative. And
so it's really about reading these momentum signals correctly.
That's the game, really. And when you combine it with individual stock fundamentals and technical setups, that's where you get those high conviction plays that can really move the needle for portfolios. Now, I should mention tech. The sector still shows good positioning overall, but after the Nvidia earnings reaction, I think we're looking at a natural cooling off period.
So you're seeing tech as needing a breather?
Exactly. It's consolidation time before the next catalyst emerges. And frankly, all this China news, the tariffs, export bans, rising competition from domestic Chinese AI companies, it's clearly weighing on the big tech names. The market's realizing that the China situation isn't just an Nvidia problem, it's a sector-wide headwind that needs to be digested.
All right, Hale, let's get to what everyone's been waiting for. Your 3 trend-confirming picks. Start with Marathon Petroleum. Make the case.
MPC is everything you want in a momentum play right now, Kerr. We're looking at a profit factor of 2.31 with a 60% win rate on our signals. But here's what really gets me excited. I mean, this isn't just about the stock. It's about the entire energy complex transformation we're seeing.
Break that down for me.
Think about it. Marathon is a refiner, right? They're not just benefiting from higher oil prices. They're benefiting from refining margins, crack spreads, and the whole supply chain disruption dynamic we've been talking about. When you have geopolitical tensions, when you have trade restrictions, when you have this reshoring of energy infrastructure, refiners like MPC are in the sweet spot.
And technically?
The technical setup is beautiful. We're seeing that 22.51 acceleration in the energy sector, translating directly into individual name performance. This is trend confirmation at its finest when sector momentum and individual fundamentals align like this. That's when you get those 20, 30, 40% moves over quarters, not years.
Aggressive or defensive play?
This is an aggressive strategy all the way. Initial position sizing, if you use stops, full disclosure, we don't. Place them tight, ready to scale if momentum continues. Energy can be volatile, but when the trend is this clear, you want exposure.
Now let's talk Primerica, your second pick. That's a very different animal.
Primerica is the defensive play that doesn't feel defensive for me. We're looking at a profit factor of 4.17 with a 55% win rate. This is a life insurance and financial services company that's absolutely crushing it in an environment where everyone's worried about financials.
What's driving that strength?
It's the perfect storm of demographics and, rate environment. You've got an aging population that needs life insurance and financial planning services. You've got rising rates that actually help insurance companies' investment yields. And you've got a company that's been executing consistently while the market's been obsessed with banks and crypto and all the shiny objects.
And this fits into that broader financial sector strength you mentioned?
Exactly. Financials at 70.04, sentiment isn't an accident, but within financials, you want to be selective. Banks are already well-owned and facing margin pressure concerns. Insurance companies like PRI are benefiting from the rate environment without the credit risk concerns. It's a cleaner way to play financial sector strength.
Full position or scale in?
This is where you can build a full position. Although it's a signal on our more aggressive strategy, the risk reward is more predictable, the volatility is lower, and the fundamental trends are multi-year in nature. It's not going to double overnight, but it's going to compound wealth consistently.
And finally, Boston properties. Real estate has been such a tough sector. What's the thesis there?
It's all about rate cut expectations and flight to quality. BXP owns premium office properties in Boston, New York, San Francisco, tier 1 markets with tier 1 tenants. Yes, the office market has been challenged, but that's created this massive valuation discount that's about to reverse when rates come down and institutional capital starts flowing back into real estate.
The work from home concerns don't worry you?
Well, that narrative is completely flipping, and it's happening faster than most people realize. BXP is benefiting massively from this back to office acceleration. Here's what's really driving it. Companies are freezing hiring and doing these drip layoffs, right? Well, guess what happens to those remaining remote workers? They're suddenly very motivated to secure their positions by being visible in the office.
So job insecurity is actually driving office demand?
Exactly. When companies tighten up, remote work becomes a luxury that fewer people can afford to maintain. Job safety increasingly means being physically present, collaborating face-to-face, being seen by management, and BXP owns the exact type of premium office space in Boston, New York, San Francisco, where these decisions are being made. Financial services, tech, startups, consulting firms, where presence equals career security.
So this is a recovery play?
It's a recovery play with defensive characteristics. Real estate provides yield, it provides inflation protection, and when rates start coming down, the whole complex re-rates higher. BXP gives you leverage exposure to that theme with best-in-class assets. We have a medium run-up of 36%, so expect a target price in the mid-90s if this story develops as expected.
All right, so looking ahead to next week and beyond, we've got Labor Day coming up, then that crucial Fed meeting, September 16th to 17th. What should investors be watching?
Next week is going to be all about positioning ahead of that Fed meeting. The rate focus is going to be that much more intense when traders return from the Labor Day holiday. We've got near universal expectations for a quarter point cut, but here's what keeps me up at night.
What's that?
Any data that changes those expectations would be an unwelcome surprise for stocks. We've got a jobs report next Friday, CPI on September 11th. If either of those come in significantly hot, it throws the whole narrative into question.
So what's the game plan?
For our 3 picks, I'm actually not worried. MPC benefits from any economic strength that might delay rate cuts. PRI benefits from higher rates anyway. And BXP is so beaten down that even a delay in cuts doesn't hurt the long-term thesis.
That's smart diversification.
But more broadly, I think investors need to be prepared for volatility around those data points. The market's gotten very comfortable with this September cut expectation. If that gets challenged, we could see some real position unwinding
Any sectors or themes to avoid?
I'd be careful with anything that's purely dependent on rate cuts. High multiple tech names, leveraged growth companies. The momentum is clearly shifting toward value, toward cash flow, toward companies that can execute regardless of the rate environment.
And opportunities?
Keep watching that energy momentum. Keep watching financials for any pullbacks that create entry points. And honestly, if we get any real volatility around those data releases, that might be the perfect setup to add to quality names that get sold off for technical reasons rather than fundamental ones.
Before we wrap up, let's do our quick lightning round. One word to describe this week's market action.
That'll be rotation.
And the biggest risk for next week?
I'd say complacency around Fed expectations.
Best opportunity?
Again, energy sector breakout continuation.
Perfect. Hail Mercer, as always. Fantastic insights. Thank you for joining us today.
Thanks for having me, Kerrigan.
Well, that's all for our weekly wrap. Remember, this is general market commentary, not personal investment advice. Do your own research, manage your risk, and we'll see you next weekend for another Smart Portfolio Strategies and Investments episode. I'm Kerrigan Vale. Until next time, trade smart and stay safe.